The cornerstone of any smart investment strategy, especially in our dynamic local market, is understanding and implementing effective asset allocation. So, what exactly is asset allocation? Simply put, it's the process of deciding how to strategically divide your investment money across different types of assets. Think of it like creating a balanced meal. You wouldn't want to eat only one thing, no matter how appealing, just as you wouldn't want to put all your investment eggs in one basket, particularly within the unique landscape of the South African economy and its markets. The main local asset classes we'll be focusing on are equities, representing ownership in companies listed on the JSE, bonds, essentially loans to the government or corporations, cash and money market instruments, offering liquidity and relative safety, and property, encompassing both direct ownership and listed property funds. Why is asset allocation so important? Because different asset classes tend to perform differently and often inversely under various economic conditions. For example, when the South African economy is growing strongly and business confidence is high, equities listed on the JSE might offer higher growth potential. During times of economic uncertainty or when interest rates fluctuate, bonds issued by the South African government or reputable local companies might provide more stability and a predictable income stream. Cash and money market accounts offer a high degree of liquidity and can act as a safe harbor during volatile periods. Property, whether directly owned or through REITs, can offer both rental income and long-term capital appreciation, though it can be less liquid than other asset classes. By strategically allocating your investments across these diverse areas, you can aim to reduce overall portfolio risk and potentially enhance returns over the long term, navigating specific nuances of the South African market. Now, how do you decide on the right asset allocation for you, specifically as a South African investor? Two key factors come into play: your individual risk tolerance and your investment time horizon. Your risk tolerance refers to your comfort level with the possibility of experiencing short-term losses in your investment portfolio. If you're someone who gets easily worried by market fluctuations, which can be pronounced on the JSE, you might prefer a more conservative allocation with a larger portion in lower risk assets like South African government bonds and cash equivalent instruments. If you have a higher risk tolerance and a belief in the long-term growth potential of the South African economy, you might be comfortable with a larger allocation to equities listed on the JSE, accepting potential volatility for the possibility of higher returns. Your time horizon is the length of time you have until you need to access your investment funds. If you're investing for the long term, such as retirement decades away, you typically have more time to ride out market ups and downs, including those specific to the South African market, and can consider a higher allocation to growth assets like equities. If you have a shorter time horizon, perhaps saving for a deposit on a property in SA within the next few years, you might need a more conservative approach to protect your capital and prioritize stability. Within the South African context, it's crucial to understand the specific characteristics and potential of each local asset class. The JSE offers exposure to a wide range of South African companies across various sectors, from mining and resources to financial and consumer goods. South African bonds issued by government and corporations play a vital role in providing stable income and diversification. Cash in well-regulated South African money market accounts offers security and easy access to funds. And the South African property market, while having its own cycles, can be a significant component of a long-term investment strategy. The key takeaways is that there's no one-size-fits-all approach to asset allocation, especially when tailored to the South African investment environment. It's about understanding your own unique circumstances, your personal risk appetite and your investment timeline, and then strategically diversifying your investments across different local asset classes to build a portfolio that aligns with your financial goals and help you navigate the South African economic landscape effectively. Remember, in the world of investing, particularly within the often volatile South African market, diversification is not just a good idea, it's your friend and your potential shield against unnecessary risk.